every market crash wipes out millions of people. So why do the same institutions come out richer every single time? What if I told you the worst economic collapses in history weren't disasters for everyone? That while families lost jobs, homes, and their life savings, a small group was quietly making billions. Not by luck, not by genius, but by design. Every time markets collapse, Wall Street doesn't panic. It prepares, because crashes aren't accidents, they're cycles. Fear and greed, expansion and collapse, repeating through history. In the 1920s, it was industrial growth. In the 1990s, it was the internet. In 2008, it was housing. In 2020, it was everything, all at once. Every generation believes this time is different, and every generation is wrong. Wall Street learned early that when optimism peaks, risk hides in plain sight. Debt feels harmless, leverage feels smart, and warnings feel boring. Meanwhile, the real question being asked behind closed doors is simple. What breaks when this stops working? Because crashes don't come out of nowhere. They come from overconfidence and denial. And if crashes are predictable, then the people who profit from them aren't reacting, they're positioning. When markets fall, most people freeze. But Wall Street moves. They short stocks. They bet against companies, industries, even entire economies. In 2008, while everyday investors were told housing only goes up, hedge funds were betting on collapse and winning big. Imagine betting against your own airplane mid-flight. Terrifying, unless you packed a parachute. Panic is where prices collapse, and collapsed prices are opportunity. Crashes don't destroy wealth. They transfer it. When fear peaks, assets go on sale. Stocks are discounted. Real estate is foreclosed. Businesses are desperate for capital. After 1929, dynasties were built. After 2008, private equity exploded. After 2020, billionaires multiplied not because they were smarter, but because they were ready. While most people are just trying to survive, Wall Street is buying tomorrow at yesterday's prices. Fear hijacks logic, and logic is expensive during chaos. But Wall Street has another advantage few like to talk about. They don't play without insurance. When risk goes wrong, governments step in. Bailouts arrive, and liquidity floods the system. Losses are socialized. Profits stay private. But this isn't a conspiracy. It's the structure. Big institutions have access to cheap capital, deep research, political influence, and time. They can wait out storms that would wipe out the average household. It's like playing Monopoly, where one player owns the bank and still complains about rent. So here's the uncomfortable question. If this is how the system works, how do you play it without being crushed by it? The answer isn't becoming Wall Street, it's thinking like it. Respecting cycles, preparing in good times, staying liquid, acting when others freeze. Wise individuals don't chase hype. They build resilience. They don't panic. They plan. They ask, what happens if markets fall 30%? Do I have cash? Am I overleveraged? Am I thinking long term? or emotionally. Wealth isn't built by predicting crashes, it's built by surviving them and acting decisively after, because the next downturn isn't a question of if, it's when. The only mystery is who will be ready. If this changed how you see money, markets, and fear, then you're already ahead. Preparation is power. And ask yourself one final question. When the next crash comes, will you panic or will you position? Thanks for watching. If you found this valuable, consider subscribing for more insights. See you in the next one.